Hi there. Thanks so much for joining me today for the latest episode of Impact Real Estate Investing. My guest today is Max Levine, founder of NICO. A few years ago, Max noticed a very big gap between traditional home ownership and renting, and he wondered what might fall in between. At the same time, he wanted to explore how to create localized wealth and neighborhood equity, and he found the solution to his quest at his own back door. In Echo Park, the neighborhood he lives in, a highly diverse neighborhood, incomes average $40,000, yet the average home sells for $900,000. Max took a huge leap in order to bridge that gap by creating NICO, a neighborhood investment company or REIT. Through NICO, locals can literally invest in the place that they live in by buying shares of local properties owned by NICO. But Max doesn't want to stop there. Listen in to hear more. And be sure to go to evepicker.com to read the show notes page for this episode. You can sign up for my newsletter so you can get access to information about impact real estate investing and get the latest news about the exciting projects on my crowdfunding platform, Small Change. Hello, Max. Thanks so much for joining me today.
Yeah, thank you so much for having me. It's great to be here with you.
So I'm really fascinated to hear because, like me, you've plunged into the fintech crowdfunding world to solve a problem. And I think your NICO is sort of a version of Small Change, although a little bit different, as we're going to discover. So it's really nice to interview someone in the same industry.
Absolutely. Great to connect with you.
First, I wanted to ask you what problem you're trying to solve.
NICO really started, NICO stands for the Neighborhood Investment Company. And we really started with an observation of just how broken housing in this country is. And initially we sort of were focused on thinking about, on one hand, you have traditional homeownership, which is held up, sort of the American dream and this example of what Americans should aspire to. Sort of the responsible thing, but it's so out of reach for so many people. And, on the other hand, you have renting, which is more accessible, lower barrier to entry, certainly more flexible. And for us, housing as being this sort of, I'll use the word choice, but it's not really a choice for so many people because home ownership is so out of reach.
Yeah, that's right.
But there's these two options, right? And so initially we started to think about how could we play a role in creating the third option that sits in between traditional homeownership and renting, one that confers some of the benefits of traditional homeownership, the opportunity for wealth creation and connection to place and sort of putting down roots. And on the other hand, was sort of flexible and more accessible the way that renting is. And so that was sort of the first observation is, if you were going to design a housing system for today's world, to reflect the realities of the real economy today, our thesis is the system would probably not look too similar to the system we have in place. And our, vision is to try and create, really a new product that is more in line with the way the economy is working today and specifically around access to capital and opportunities for wealth creation for folks.
Right. Yeah, I always think of rental as not providing comfortable stability.
Yeah.
For example, when places gentrify, you can't be certain that your home won't be taken away from you, which is troubling.
Yeah, correct, right? And I would say it's even deeper than that. I think that's a big element. Housing stability and security is a big element of it. I mean, even the word, right? Even the words landlord and tenant, those are words that are rooted in, medieval servitude, right? That whole paradigm and the whole way that relationship is set out is one that is, not rooted generally in equity or respect, right? And so I think there's also sort of an element where that relationship between, residents and property owners or landlords and tenants needs to be radically reframed. And I think housing stability and security is a big part of the outcome of what that could look like. But I think there are other ones as well. For instance, I think there's a real bias against renting as an option. I think it's viewed as being less than homeownership.
Right.
And I think that narrative, that exists really broadly needs to change, because the reality is, renting is, if it evolves a bit, I think has the potential to be a better option than homeownership for a lot of folks.
Yes. Yeah.
And that's part of the future that we're trying to build through our product. And I would say the other, sort of big thing that we're trying to solve for is, when you ask people where they live, where home is, 9 out of 10 times they'll say, hey, I live in Echo Park, or I live in Inwood, or, I live in Greenpoint. They'll sort of lead with the neighborhood, right?
Mm-hmm.
And, for us at NICO, the neighborhood as a unit of organization to us is sort of the most important unit of social organization that we have, right? Because it's larger than your family unit, but it's still close enough and personal enough that you develop really meaningful connections with folks in your community, whether they're neighbors or small business owners or organizations that you support or volunteer with. And so for us, in thinking about how to create a new housing typology in between renting and homeownership, it was really important to think about how we could sort of give the appropriate place and the appropriate role to the neighborhood. And NICO, which is the neighborhood investment company, has really sort of come out of both of those lines of inquiry.
That's interesting. So how does NICO work?
We have launched what we believe is the world's first neighborhood real estate investment trust, or neighborhood REIT. And what that means is that, we're a real estate investment company that owns a portfolio of income producing properties and potentially other real estate related investments within a specific neighborhood. And so the first neighborhood REIT is here in Echo Park in Los Angeles. It's called NICO Echo Park Benefit Corp. And it's a company that has a share structure that owns portfolio property. Today we own 3 rent-stabilized multifamily apartment buildings, one of which is a mixed-use building with some retail on Sunset Boulevard. And people can invest into the REIT through our website, mynico.com, and become shareholders in the company that owns this portfolio of property. And our vision with this and our, what we're trying to sort of build is we want to create an opportunity for thousands of people within a community, many of whom, in the case of Echo Park, most of whom are excluded from being homeowners. We want to create a way for them to be able to build wealth, build belonging, and sort of participate as primary financial stakeholders in their neighborhood through a responsibly managed, impact-focused neighborhood investment company. And that's what it is.
So why Echo Park?
There's a lot of reasons why Echo Park, but I don't think that, this concept is limited to Echo Park. I think some of the dynamics that are playing out in Echo Park and have played out in Echo Park are playing out in communities all over the country. Some of these reasons are sort of specific to Echo Park, and some I think are speaking to the broader dynamic that we see in communities like Echo Park all over the country. So the first thing I would say is that, Echo Park is an incredible, dynamic, beloved neighborhood, right? Dodger Stadium is here. There's an incredible music and creative community that's been here for a long time. And, people who live in Echo Park choose to live there because they love what this community is about, and it is speaking to them, and it's the place that they want to call home, right? So there's a lot of neighborhood love here. At the same time, the median household income in Echo Park is approximately $40,000 a year. The average home price is over $900,000.
Oh.
And, about 75% of the households in the neighborhood are renter households, right? And so that speaks to this huge gap where homeownership is really out of reach for a lot of folks, right?
Yes.
And there's a lot of love, and there's, a desire to be more secure in being a resident of this community. And, Echo Park has experienced a significant amount of gentrification. It's a neighborhood that has experienced a lot of change over the last 20 years. I would say, maybe especially over the last 10 years. And that dynamic creates, which we primarily view through a lens of inclusion or exclusion, right? Who is benefiting, who is accruing benefit from this change, who is being harmed by the change. And so this dynamic where people love their neighborhood, they're excluded from being homeowners because it's just too out of reach, and the neighborhood is changing in a way that feels kind of out of control. We want to create a way that over time, and this isn't something that can be sort of solved in 6 months or a year or even 5 years, but we think over 10 years or 15 years or 20 years, if you have a way for many more people, radically more people within a community to be able to build wealth in a fair, flexible, incremental way, we think that that could drive some very, very special outcomes relative to the current paradigm if those people are able to build wealth through investing in their community.
So can anyone invest, or do you restrict investment to locals or people who live in Echo Park?
Yeah, so investment is open to local people and to non-local people. Within the REIT, we have two classes of shares. We have a class of local shares, Class L shares, and a class of non-local shares. And so it's open to both groups, though the local shareholders have some benefits on some concrete terms of the offering, like the redemption plan, which is how people would request to get their money out. And also, and I'd love to talk a little bit more about this, we're a benefit corporation, sort of at a DNA level for our company. We have a legal responsibility to balance financial returns to our shareholders with social and environmental impact of our business on stakeholders, right? So on a group of people beyond just our shareholders. And our local shareholders are one of the key stakeholder groups that we will count on to help inform specifically our non-financial objectives and our non-financial measurement and performance.
Right. So what percentage of your investors actually live in the neighborhood to date? I know that might change, but I'd be interested to know that.
So we launched the offering, and I should say the offering itself is a Reg A+ offering, which means that NICO Echo Park is a public, non-listed REIT. So we're regulated by the SEC. There's a lot of sort of robust reporting, audited financials, all sorts of stuff like that.
Oh, I know it well.
Yeah, and what that allows us to do is, whereas many real estate investments, most real estate investments are only open to, what the government calls accredited investors, which is another way of saying rich people. By being a public company and using this type of offering, we're open to both accredited investors and non-accredited investors, or non-wealthy people. And so we've set our investment minimum at $100, which is very low for this type of offering. And our objective in that is to make sure that as many people as want to within the community and nationally have the opportunity to support this model and participate in this model. We haven't publicly disclosed the breakdown between local and non-local investors so far. I think that we'll probably do that on our supplemental filing that'll be coming up pretty soon. So I'm going to sort of hold on answering that question. I'll say that it's a significant portion of the investors who've come through the offering.
Yeah. Well, that's really good to hear. That's what I hope will happen. So when someone invests $100, what do they get?
Anyone who invests into the offering becomes a shareholder in the company that ultimately owns the portfolio of properties. And so people who become shareholders, they own shares in NICO Echo Park Benefit Corp. And what accrues to them are, sort of the pro rata profit and appreciation that, we expect to generate as long-term owners of these properties. And I'll also say that, one question that comes up a lot is people want to know whether investing, in this means they own a specific unit or a specific property. The answer to that is no. They become a shareholder in the whole portfolio, and the portfolio, we expect to grow it pretty substantially over time. So it's not just investing into the properties that we own today, it's also investing into the company that will own additional real estate assets within the neighborhood as we grow it.
So they're really in it with you, and that's a pretty big responsibility for you, I imagine. That's how it feels.
We view it as a big responsibility, and I would say the big responsibility, is sort of twofold. I should say at least twofold. One is when you take investor capital, they're trusting you to make decisions on their behalf, and be stewards of that capital. So I'd say that's one level of responsibility that we view. And I would say the other, sort of major level is this approach to neighborhood investment through a benefit corporation structure, through a neighborhood REIT. This is really the first of its kind, right, in a lot of ways. And so, we have a responsibility to be incredibly thoughtful and understand, the context that we're coming into and, in the neighborhoods where we'll be active in pursuing this model. And I think we've set a very high bar for ourselves, right? We've set a bar where, we are trying to balance, financial returns to our shareholders. And we believe that, market-oriented solutions are an important part of, what moving through this pain that, so many people are in around housing in their community. We think market-oriented solutions are a big part of that solve. And that balancing, it's going to take some time to get right? And I think that we have sort of designed our impact framework and our product in a way that is intended to evolve with stakeholder input over time, right? So we aren't making a claim that, hey, this is what it is and we're going to get it exactly right. I think we built it in a way that gives it space to evolve into what it needs to be in response to stakeholder input and feedback and sort of our community over time. And balancing all those things will be a challenge, but that's the challenge that we've signed up for, and that's the future that we're trying to create.
Yeah, I mean, we have non-accredited investors as well, small change. And I sometimes think that one needs to feel even more responsible for $100 when it comes from someone who doesn't have a lot more. It's maybe more meaningful.
Yeah.
I don't really quite know how to put it, but that $100 is a stretch for a lot of people. And so there's this extra feeling of responsibility around it.
Yeah, we certainly feel that way.
Under a Regulation A+ offering, you can, at the moment, raise up to $50 million. Is that right? Or is it $50 million a year? I can't remember.
It's $50 million per year. Yeah, we can raise up to $50 million per year. And
is that what you hope to raise?
Yeah, so, to date, we've raised, prior to launching the offering, raised about $30 million of real estate, debt and equity capital. We use that to acquire the seed assets. Since launching the offering, we've added to that. And I wouldn't say it's my expectation that we're going to raise $50 million, in the first year or two, because I think the nature of the problem that we're trying to solve, or the problem that we're trying to be part of solving, is that folks who have been excluded from wealth creation, they don't have $50 million sitting around, right?
No, and it takes a lot of education. I think real estate investment is difficult and requires a lot of education as well. So it's hard. Yeah.
Yeah, so I would say we hope to make really good use of the offering, but our priority is less about how much money we bring in through the offering and more about how many people, specifically how many local investors, are participating in the model. That's really our, sort of North Star for the next couple of years.
So how long will this offering or this REIT remain open?
Yeah, so again, I have to be a little careful about what I say with securities law.
Sure.
So I don't want to sound evasive. My understanding is that we can keep it open on a rolling permanent or semi-permanent basis, subject to renewing some of the paperwork.
Okay.
So it's our intention to basically keep it open.
Okay. That's pretty exciting. So can you tell me a little bit more about the buildings in the REIT and how you're hoping to expand your portfolio? I heard you say that some or all of them are rent stabilized. Can you expand on that a little bit?
All of the buildings that we own today are rent stabilized. We're not limited at the REIT to only investing in rent stabilized buildings, but we like that asset class. We like that type of building a lot. When I say rent stabilized, I'm talking about in the city of Los Angeles, there's a rent stabilization ordinance, which is a very broad program. any multifamily buildings, which I think is 2 or more units that were built prior to 1979, are part of this program as a default. So it covers, significant portion of the multifamily housing stock in the city of Los Angeles. And, what that program currently does is basically puts very strong protections in place for existing tenants, right? And so the amount that property owners can raise rents on existing tenants is capped at a rate set by the city, for example, and it's more regulated than market units. So we really like, those protections. And, we are, as I mentioned earlier, we're sort of trying to, reframe this relationship between, residents and property owners. We're landlords and tenants, in industry speak. And we love the fact that we can invest in assets where strong protections for tenants are built into the asset price. We sort of love that as an asset class. The buildings themselves, there are 3 buildings. They're all in core Echo Park. We have one at 1650 Echo Park Ave, one at 1416 Echo Park Ave, which is a block off the intersection of Echo Park Ave and Sunset. And then we have a property at 1461 Sunset, which is a few blocks down Sunset from Echo Park Ave. So they're very proximately located. The portfolio totals 80 residential units and 4 retail stores, all of which are occupied by locally owned small businesses. And, we are targeting future investments that are rent stabilized, some that are, maybe retail investments, some non-rent stabilized properties, mixed use properties. And, our investment parameter is sort of, it's geographic, but it's not limited to Echo Park. So the way the offering describes our investment parameters are, Echo Park, Silver Lake, and proximate communities. So that gives us a bit of room to look beyond this core Echo Park, though our initial portfolio is very concentrated, historically significant. All of the assets were built in the 1920s approximately, though if we've got any history buffs on here, there might be 10 years plus or minus on that. But they're all, sort of very recognizable buildings that have been part of the community for a long time. And, part of what that coupled with the protections under the RSO program does is it means that the buildings are occupied by a really socioeconomically diverse set of residents. And that also is, important to the type of product and community and inclusion that we're trying to build through our product.
So when you have a rent stabilized building, is it hard to make enough money to cover the expenses? And how do you cope with that? You have pretty lofty goals here, and keeping costs reined in is hard.
I would say that all of the assets, like asset prices, just this is more broadly than our building, but, asset prices, really reflect expected future returns, right? And so all of the properties are comfortably covering their expenses, comfortably covering their debt service. They're all conservatively financed with long-term fixed rate debt capital. And the portfolio has been highly occupied since we acquired it. So, we continue to manage to a high level of occupancy, and the pricing of the assets and the way these types of assets are priced and valued is reflective of the protections that are in place. And so they're all doing great on a property level.
So I have to say it's a lot, and kudos to you. You're actually 3 companies in one, real estate developer management company and a crowdfunding platform, and that's a lot.
Well, I would say that we're not really a real estate developer. So, we won't do, as we're currently set up now and under the terms of the offering, we're really not set up to do ground up development or to do even substantial renovations.
Well, real estate owner then, which is different than property manager.
That's true, yes. So we're really an asset manager, a property manager, and then we have, the offering and, the sort of capabilities that go with managing that type of offering.
Yeah. So how do you hope to scale?
Yeah, so we have ambitious goals for this company, and I would say that, we hope to be doing sort of regular acquisitions into NICO Echo Park, over the next number of years. I'm not sure exactly what that looks like from a number of units or a capital invested standpoint, but we believe that this neighborhood, has the opportunity to grow pretty substantially and to grow our impact and grow, the model. And then separate and apart from that, we're actually in sort of a fourth line of business, which is we have a non-real estate owning sponsor company, which actually owns sort of the functions that you outlined before. And through our structure, we seek and expect to be launching additional neighborhood REITs in other neighborhoods around the country, probably starting next year.
Wow. Okay. Big goals. So what's the biggest challenge you've had?
It's a great question. I mean, running a company through a pandemic has certainly been challenging.
Oh, yeah.
Having a team that is, very much in sort of the formation phase and, team building phase have to go remote and get to know each other over Zoom. We have team members who have not met in person, people who've joined our team since the pandemic started, and so I think that's a challenge. And I think the other, I would say the sort of more macro challenge is that what we're doing is a bit counterintuitive, right? It's on a populist level, it's a bit counterintuitive. And so what I mean by that is to say that the relationship that we are trying to realign, at its core is really kind of the relationship between investment capital and what motivates it and how it defines success with people in communities like Echo Park who've had a pretty negative relationship with investment capital, right? Because they've been excluded from it and it's come in. And I think the perception, which I believe is largely, accurate, is that when capital comes in, it typically means that, there is risk to me as a longtime resident, risk to me and risk to my neighbors as longtime residents, right? And so I think that trying to start to solve some of these issues through being an investment company, I think that's a bit of a barrier for people to get over. And I think that's pretty fair and pretty deserved. But, our model is such that we're really sort of taking that on. And, I think the great sort of untold story of gentrification and neighborhood change is that real estate, really was not an mainstream institutional asset class 20, 25 years ago, right? And now it is.
Yes.
It's a big part of the allocation. And so I don't think that capital is the only sort of factor. I think the housing shortage is also one. And I think, there's a lot of other ones. But, the pressure that huge organized flow of capital has put on, neighborhoods like Echo Park is really hard to understate. And so to our view, to Niko's view, and to our theory of change, until that powerful, large flow of investment capital can be realigned to actually be viewed as a tool and a resource for stabilizing communities and including folks who were previously excluded in the wealth that's created through that investment, we're not going to be able to really solve, these issues at a root level, right? And so I think it's a bit of a counterintuitive move for people who are used to viewing investment capital or a company or an investment company in a specific way, which is this feels like a threat to me and my neighbors, into something where this offering and this way of being can actually help to stabilize this community and help to drive the types of outcomes that are important to me, in my own community.
Yeah.
So I think, that's sort of a lot to get your head around. And we understand that, that'll take time. And where the rubber hits the road is sort of our actions and the way that we're managing this portfolio and balancing our various priorities. Are we doing that in a way that is genuine and, sort of worthy of people's trust, right? And that'll take some time to earn that. And that's part of our, journey here.
Yes, yeah. Just shifting gears a little bit, are there any other current trends or innovations in real estate that you think are really important to the future of cities or the future of housing?
I think that the sort of renewed focus now on the equity or disequity that's built into the public realm and also into the sort of planning process.
Yes, yeah, I've been watching that. It's interesting.
I think that conversation is super exciting and has the opportunity to really reframe how people and how communities are able to have agency in terms of what happens, within their community. I think public projects, public space projects, development projects, we're certainly seeing and starting to feel within sort of the real estate industry, the pressure that comes with that, and I think there's a genuine attempt by, more and more private sector actors to take that seriously and to legitimately and earnestly try and figure out how to be engaged with the community and to beyond just sort of the tokenism of, hey, we'll throw in a garden, have a couple of feedback meetings or something like that. Like, I think there's sort of the start of a groundswell of, we need to build equity into how we think about development in the public realm. I think that's super interesting and very important. And I hope we can play a role in that. And then I think things like technology that is helping to create more efficient, less expensive, quicker ways to actually generate, new housing. There's no path out of this housing crisis that doesn't come with building a lot more housing. That's not the business that we're in. But I think that construction is super painful, and it's sort of in the Stone Age, right, in terms of how that process actually works on a deal level. And so I think anything that makes that process, more transparent, more knowable, less risky, more scalable will help to create a lot more housing. So I'm very excited about that. Yeah. And I would also say that the sort of, more broadly, shift in focus by institutions and family offices and, other sort of sources of that mainstream real estate investment capital towards strategies that are legitimately ESG strategies or impact strategies. I think that is super exciting and very important. And for us, we always come back to what is that relationship between capital and what capital is seeking to do, and how is that aligned with the financial and non-financial impact of communities and people in communities, right? And so I think that shift in awareness and that shift in priority towards strategies that are legitimately focused on ESG and impact, I think that's a great first step in starting to reframe that relationship at scale.
Yeah, because in the end, without shifting capital, not much is going to happen.
Right, and if you think about affordable housing as an example of this, like, we're pro affordable housing, but the structural limitation of subsidized affordable housing,
it's huge,
is that it requires a subsidy, right? And so, like, the subsidy that it requires is limited, right? And therefore, there's only so many tax credits that go out every year.
And it's time consuming. It doesn't let you produce affordable housing fast, which we need to do.
Yeah, and exactly. And so, we come to this place, and NICO's really built around this theory of change, that until market forces of capital, right, until market rate capital, which is a huge, effectively it's an infinite pool when you think about how the capital gets recycled, until the priorities of that change and until the structures around that change to be focused on delivering financial returns and acknowledging the non-financial impact that capital has, until that happens, the scale of any potential solutions that count on subsidy or philanthropy, which is a form of subsidy, it's the scale of that potential impact is just limited when you look at the scale of the market. Yeah. So we're excited to start to see that shift a little bit.
Well, this is it's been really interesting, and I've really enjoyed learning about NICO, and I'm especially looking forward to see what comes next. So thank you very much for joining me.
Great. Thank you so much, Eve. And thank you also for all the work you've done over the years with small change and with impact real estate. We're huge fans of it, and very appreciative for your leadership in our nascent industry.
That was Max Levine. His life is focused on building equity through real estate. With NICO, he's working to bridge the gap between those who own assets and those who don't. If you live in Echo Park, you can invest in Echo Park. And what you invest in will ensure that the neighborhood remains available to everyone, for everyone. Niko's first 3 buildings are rent stabilized. It's a very big goal, and Max is chipping away at it. You can find out more about impact real estate investing and access the show notes for today's episode at my website, evepicker.com. While you're there, sign up for my newsletter to find out more about how to make money in real estate while building better cities. Thank you so much for spending your time with me today, and thank you, Max, for sharing your thoughts. We'll talk again soon, but for now, this is Eve Picker signing off to go make some change.